All right, everybody. Welcome to the Investor's Guide to Thriving. It's October 15th, and we're in the home stretch for the U.S. election. It seems like that and the prospect of a second major stimulus bill are dominating the outlook for markets. We'll be with you every step of the way, Thursdays, 7 p.m. Eastern through December 3rd. You can tune into our weekly webinar series and get all the latest updates in between episodes of BERMAN'S Call, which has now returned to its historic Monday time slot at 11 a.m. Eastern Time. Well, we hope you can help us write a better history by joining Larry and I to support childhood leukemia research at the Sick Kids Foundation and Alzheimer's and dementia research at the Baycrest Foundation. If you'd like to make donations, please use the links in the survey you'll receive after the event. This is how we're able to track and match your generosity, and we thank you so much for those of you who have already donated. The survey is also your gateway to access the webinar replay. It'll arrive in your email tomorrow morning. Just tell us how we did tonight, and you'll get a link to access all of the above and submit questions for next week's webinar. We're thrilled to be able to bring you Investor's Guide to Thriving in large part thanks to the support of our excellent partners, including National Bank Direct Brokerage, who support not only this series, but also Larry's Investor 101 videos on YouTube. Be sure to check those out, and while you're there, hit the subscribe button and the little bell icon next to it, and then you'll be nicely set up to get updates on your phone every time we post a new video. They're great because they're just a couple minutes long each, and you can learn a little bit about some corner of the market. The Investor 101 videos are great for those of you more sophisticated investors to educate your friends and family about how to get started with investing. And for those who are looking to get either started with investing on their own or looking to make a change and maybe get access to a state-of-the-art investor platform, we have Ann Lee here from National Bank Direct Brokerage to give you an overview of their platform as well as how you can get 200 free trades. Ann, why don't you tell us some more?
Perfect. Thank you so much, Jared, for the introduction. So my name is Anne, and I am one of the business development managers at National Bank Direct Brokerage. And for over 30 years, our aim is to encourage clients to play an active role in managing their finances through self-directed investing. We're very happy to be here again this season in support of Baycrest and Sick Kids, and of course, all the work that Larry has done for these foundations. As for tonight's topic, I will be going over the different types of orders that you can place, so market, limit, and stop orders. But before I start with the fun stuff, typical disclaimer, I'm here to remind you all not to take anything that I say as actual advice or recommendations. National Bank Direct Brokerage is self-directed, so that means that it is expected to do your own research and due diligence. So as I mentioned, we'll be going over a bit about the different order types you can place on our platform. So we have the option for market orders, limit orders, and stop orders. Now, taking a look at the next slide, you'll see one of our order ticket styles. So I like to call this one our compact order ticket, as it is easy to minimize, and you can also move the ticket around the screen. The next slide will show you the other version of our order ticket, which I like to refer as our classic version. And it's probably something that a lot of you are familiar with already. Either way, both order tickets show you 3 different order types, and now you have to decide which one would work best for you. The next slide will show you the first order type, which is market orders. It is the most common order type, and it's typically the default selection. So buy and sell orders at market will be filled at whatever the best price is in the market at that time. So it's good to use if you want your order executed as quickly as possible. And then this slide here will show you when you might use a market order. So typically it's because you want a quick fill and you're willing to pay for it, or you're trading a security that is highly liquid with a narrow bid and ask price, or you're buying or selling a few shares at a time. Now, this slide here will give you an example as to how it's like to place a market order, as well as a couple things that you should keep in mind. So for this example, we have Suncor, a large cap Canadian equity, and it's important to look at things like the bid and ask, the trading volume, and the history if you want to dig a little deeper, as it can give you a good look at the stock's liquidity, at least enough to justify market orders. I would say take note that the bid and ask spread is rather thin, as well as the high volume. Now, this is the scenario if you had more large cap equity, but on the flip side, if you take a look at the next slide, you'll see the same overview page, but in this case, it's for a penny stock called Nuvo Pharmaceuticals. So some factors to consider like the bid and ask and the volume, but in this case, take note that the spread between the bid and ask, as well as the low trading volume, and as well as the sporadic trading volume, this can make market orders rather unpredictable and maybe even a little more risky. Moving on, the next slide will show you the basics of a limit order. So this is good if you have a specific price in mind. If you're buying, your limit price is set for lower than the current trading price and will be filled at the limit price or lower. And if you're selling, your limit price is set for higher than the current trading price and will be filled at limit or higher. In both cases, the price is guaranteed, but if the market price never hits your limit price, then your order won't be filled. Now, when would you use a limit order? So you'll see on this slide a couple reasons when and why. So you probably have a specific price in mind. Maybe you're trying to buy or sell an illiquid stock and you want to have some control on the price. Maybe you want to trade a large amount of shares, or maybe you're just going on vacation and want to just set it and forget it. Now let's take a look at the next slide to see the example in action. So at the first arrow on the left, if you placed a buy limit order for Suncor at $16.25, you would most likely get filled at that price or even cheaper. Now on the other end, if you place the same order 30 minutes later, you might have very well missed that boat and your order won't get filled. And finally, on the next slide, you have stop orders. So with stop orders, they are orders to buy or sell whenever the current price hits the trigger price or moves past it. So keep in mind that for sell stop orders, or also known as stop loss orders, the trigger price is placed below the current market price, and vice versa with buy stop orders, the trigger price is placed above the current price. Now, when would you use stop orders? The next slide will show you a few scenarios, but typically you would use stop orders to either protect your capital gains or to limit your losses. If you're long on a position, you would usually use a sell stop, and if you're managing risk with a short sale, you would use a buy stop. Now, keep in mind that with stop orders, you risk having the order filled significantly away from the stop price, as well as the order not being executed during volatile instances when, let's say, a stop can gap up or gap down. Now, going specifically into stop limit orders, you'll see a brief explanation on that on the next slide. So it's the exact same concept as stop orders, just this time you're setting two prices, a trigger price and a limit price. So basically, once your stop price is triggered, a limit order will come into effect. This gives you precise control over when your order should be filled, but it's not a guarantee for execution. And then the next slide will show you when you would use stop limit orders. And they are commonly used to lock in profits, to limit losses, or even to enter into a new position if, let's say, you wanted to time the market and potentially catch an uptrend. Again, some of the risks are that there's no guarantee for execution, as well as you may also be stopped out too early. The next slide shows how you would enter a stop limit order on your order ticket on our platform. So take note that it is a sell order, so your price type is a stop loss. And then you'll have the two boxes to enter your trigger and your limit price, as well as a good till date if you wish to change that. And then to put this into action, on the next slide, you'll see an example scenario. So let's say you bought XOM in this case at $32 a share. Let's say you've been holding it for a couple weeks, and as you can see in the charts, it's generally going up. You decide to place a stop loss order at the beginning of June, trigger price of $49, and maybe you put a limit price of $48. Now, as you can see how the rest of the chart has played out, you missed a gap up, but you also secured your profits, and you're probably happy that you did, as the price has steadily gone back down to almost break even. Now, on to the final good stuff and the next slide. If you didn't know, National Bank doesn't charge any commissions for buying and selling all Canadian and US ETFs. So whether you're buying Vanguard, BMO, or Horizon ETFs, it's zero commissions. So to take advantage of that, make sure that each time you buy or sell the ETF, that it's 100 shares or more. Make sure to also do the trade online. And finally, make sure all of your documents are set to e-delivery. And that's pretty much all you need to do to not pay any commissions on ETF trading. And now, if you haven't heard of us until today, then you probably haven't heard about our low commissions. And we have something for everyone. So if you're already a National Bank client, you can trade for $6.95. Maybe you're under 30 years old, you can trade for free. And then $4.95 if you go over the 10 free trades that we give you every single year. Or maybe you classify as an active investor and you're doing more than 100 trades a quarter, then you're only paying 95 cents a trade. Now, because we are excited to be part of Larry's tour this season, we have also included an extra perk to those that have taken the time to join us, especially during these rather interesting times, if you want to call it that, and to put it very mildly. So for new clients that open an account from now until the end of the year, you will get 200 free trades to use for 1 year. And the conditions are simple. You should be a new client to us, enter the promo code during the account opening, and keep in mind that these are for trades that are done online. And finally, make sure all of your documents are set to e-delivery, and that's pretty much it. Last but not least, we also have some short, useful videos on our YouTube channel in case you wanted to view more about our trading platform. And to conclude, if you have any other questions about our offering, my colleagues at the call center will be more than happy to assist you, or you can also reach out to us directly by email. Thank you again for your time tonight, and now on to our next speaker.
Okay, we're very grateful for the partnership we've had with BMO ETFs since 2009. They're the original and premier sponsor of the Investor's Guide to Thriving, and they continue to lead the Canadian ETF industry, offering an ever-increasing array of ETF tools to help you grow your portfolio. Here tonight to show you a few examples, just down the street from us in Toronto, in Montreal, here is Alain Debian, ETF specialist from BMO ETFs.
Hello, Jared. Hello, everyone on the call. It's really great to be with you tonight. If we go to the next slide, as you could see, we think we know ETF, but I would say also that we're passionate about exchange-traded funds. Personally, I've joined the industry, and you're seeing below the Canadian ETF landscape in 2010. I was the first to be hired on the sell side with Kevin Prince and Mark Webster, and we covered as ETF specialists at the beginning 10 years ago, the Canadian landscape. At the time, just to give you an idea, in 2010, we had $1 billion of asset under management. 10 years after, we're now at $68 billion. think what is interesting also to see is in 2009, basically the industry was at $35 billion. We have roughly multiplied by 10 the industry 10 right now. And if I look at the net sales this year in the exchange traded funds market, it's now over 36 billion, which is basically the AUM that we had in 2009 in the industry. This year has been the best year ever for the exchange traded fund markets. And I think people were quite busy on the institutional side, on the retail, and on the discount brokerage to alleviate in their portfolio the best tools. Tonight, I'm going to speak a bit more about the asset allocation. A couple of key things, what we see in the portfolios is a lot of overly concentrated portfolios, a lot of market timing in the portfolios, a lot of lack of rebalancing, and a lot of emotions taking over. Asset allocation is really a solution for a lot of Canadian investors. Something else also, right now, half of the asset allocation, are in cash. Since the beginning of COVID, cash and Canadians are hoarding cash. Since the beginning of COVID in Canada, people have put $125 billion into savings. We do believe that asset allocation and solution like there's other solutions to improve the performance of your portfolios, and asset allocation is really key in terms of the performance there, rather than being over concentrated in a couple of stocks. If we go to the next slide, so we think this is the most important decision that you can make as an investor, the allocation between fixed income, equity, and cash. And we do believe that asset allocation really matter, because the asset allocation is going to give you the largest impact on your portfolio long term, rather than just doing stock picking. The decision basically for a lot of you is, do I want to be conservative? Do I want to be balanced? Do I want to be growth in the portfolios of the most largest and liquid ETF in Canada? I think asset allocation makes a lot of sense. You can have a global market exposures. You can target your ideal asset allocation. You could be disciplined in asset allocation and also in rebalancing. And this is so low cost to do this. Right now, in the big 5 ETF player in Canada, there's 4 that offer a comprehensive suite of asset allocation. The most expensive is Vanguard. BMO, Horizon, and iShares are 20% cheaper. Rather than being at 22 basis points, we're all at 18 basis points. If I look at BMO Exchange Traded Funds asset allocation, ZCon, ZBAL, ZGROW, they have inside of their asset mix the biggest ETF in Canada, ZAG, ZSP, ZEA, ZCN, ZEM. So you've got the asset allocation with the largest, most liquid ETF in Canada at 18 basis points. On the next slide, and I think this is going to be really important in the next 10 years, we bring in the market the first asset allocation ESG in Canada, ZESG. For the first time in Canada, you have access to a balanced portfolio rebalance with ESG index ETF. Again, there, the performance is great. The fees is not more expensive than if you were in any big normal index ETF. It's 18 beeps, the same than our ZBAL. So this is really a first in Canada. And really our prediction is the next 10 year will be for ESG what was ETF in the past 10 years. And we're going to see those 2 segments in the Canadian market grows tremendously, ETF and also ESG. And now it's never been so cheap to buy asset allocation, and asset allocation that takes into account your values with ESG solutions. This was, in a nutshell, basically a couple of key points around the ETF industry, BMO ETF, the asset allocation. I have to say that we also have active asset allocation. I'm thinking now about Larry's portfolios. That could be really a must. Now I'm going to present Larry. I know he's going to take the rest of the presentation. For a lot of you, you're seeing Larry on BNN, you're seeing Larry in the media, but for us, he's a pioneer in the ETF industry. I remember him at the beginning when I joined the industry 10 years ago on the ETF. You maybe don't know this, but there's a lot of the ETF in Canada that has been created because Larry gave a feedback to a lot of providers. So Larry, it's now your turn.
Okay, hopefully everyone can hear me. Merci beaucoup, Mr. Desbiens. Many of you may not know, but Hélène Desbiens, I believe for the second time, has been voted as the ETF Salesman of the Year. So a lot of BMO's success has been with their longstanding relationship with Hélène. And I would encourage you, for those of you on LinkedIn, to seek him out and follow him. He posts lots of really, really good stories and links on his feed. So highly recommended if you're looking for some extra knowledge in the ETF space. So thank you again for that, Alain. Thank you to BMO for being such a great ambassador and educator of ETFs and partner for us here and specifically me on Berman's call. So, you know, obviously there's not a lot more important than the U.S. election in terms of what many aspects of the markets look like in the coming months and years. But a few things caught my attention this week. We saw IMF, International Monetary Fund, has a conference, and they released their new update, and it was actually staggering because the IMF has been the lender of last resorts to emerging countries, basically that have been struggling. They have difficulty borrowing money on their own. They have to borrow in US dollars. The IMF comes in. They institute a technocratic overlay to their budgeting, and they kind of get them back in shape. But largely, the IMF has been an advocate of balanced budgets and fiscal prudence, and they basically said no room for that today, may not be for years to come. Interest rates are low, just borrow and spend. So, you know, we're going to get a lot of money spent to get us through the worst of COVID, and this is called the Reflation Trade, which I think ultimately leads to some inflation versus the decades of deflation that we've been in. So I want to talk about that and how it relates to different asset classes and markets tonight. Obviously, an update on the election and what's going on there. And I just did a quick update on Worldometer's COVID watch. And basically what it's saying is that today we see the biggest on a global basis, the biggest single day in terms of COVID cases. I just updated as a few minutes ago. We're looking at 383,000 cases today, again, single highest day that we've seen to date. And so now we're looking at getting 1 million new cases globally every 3 days. Where it took a month to get 1 million cases, you know, back, you know, at the beginning of this thing. So obviously a lot more testing, and that's a factor, but really this thing is spreading globally. They shut things down. We saw France, Macron institute a curfew. We're seeing shutdowns again in the UK and Germany. Italy spiked again. It's clear we can't get past this thing without better viral treatments and vaccines, and not only getting a vaccine, but getting people to take it so we can develop a herd immunity. And many of you probably have heard that people are now getting COVID multiple times. And while you don't want this thing, right? And yes, there's treatments, but there's in many instances long-term side effects that could have permanent impairments on people. And you don't know if your genetic makeup is one of those people that's going to have, pretty severe side effects. So this is going to be an overhang for a while. And we weigh that against the fiscal large S. Okay, so here we go. So when the IMF and you can, for those of you get the Financial Times, or you can go to the IMF website, it's all there. You can read the report if you want, but here's a snippet from the Financial Times that came out literally, I don't know, 6 to 8 hours ago. I was putting together a lot of the final slides today, and I thought this would be something that we could talk about and feature. So, who can borrow and spend with no limits? Well, it's governments that can print money to monetize it, because one of the challenges of this monster amount of debt we're getting is that when they issue the debt and the bonds, that takes money away from other asset classes, like equities in particular. And you get what they call this crowding out effect. So, but as long as governments can borrow and print, and it doesn't affect their currencies to a great extent, and it doesn't affect their ability to borrow and doesn't push interest rates up too much, then this can go on for a long, long time. And so the people who have trouble borrowing are the ones that can't do that, where places like Turkey, who have to have extremely high interest rates in order for people to want to buy their currency and ultimately their debt. So Canada, the US, Europe, Japan, they have benefits of being mature economies, where a lot of the developing economies don't have that benefit, and therefore need to borrow in dollars, and when their currencies weaken, causes them undue stresses. So the US dollar is a wrecking ball, so to speak, and the stronger the US dollar gets, the worse the world is. Flight to safety into the US dollar. And so all these things are going to be very, very, very important in the years to come. And everybody says the death of the dollar. And I continue to say, and I'll take the other stand against anybody, that as long as the US is the biggest economy in the world and maintains reserve currency status, and the markets have no trouble with the Fed printing money, this can go on for years. And I used to think that we were going to go a lot lower still. And this is the first time we've had a major global recession. It's been biggest ever. We've had, in terms of the global scope of this recession, but it's also been the biggest, and the ability of them to not only come with fiscal support, but to them use monetary support to smooth out that new debt. So in other words, printing money. So this is modern monetary theory. I talked about it all summer. I've talked about it for many, many years, actually, on BNN and in my road shows. And this is coming. And this might just mean that asset markets maintain a stupid, ridiculous, crazy, unheard of valuation, which makes them riskier and riskier and riskier. And the sad part about it is I can't tell you with any certainty when it'll end. But one of the keys to me is looking at the dollar. So a lot of people don't understand what the dollar means and the reserve currency means, in that when you sell a dollar, you got to buy another currency, right? Or you got to buy a piece of gold or a piece of land, but you're still then denominated in dollars. So when you sell the US dollar, you can buy the Canadian dollar, you can buy the Japanese yen, the Great British pound, the euro, the Chinese yuan, South Korean won, and so forth. But the monetary base isn't big enough. It is in Europe and it is in China, but it's not big enough anywhere else in the world. Their economies aren't big enough to maintain a reserve currency status. And Europe is fractured, it's broken, it's not getting fixed anytime soon. And we're not going to see a lot of money rushing to euro. Sure, for a trade, maybe for a year, the US dollar euro rate goes from, sub 110 to 120, 125. But then at that point, their export business, Germany in particular, starts to suffer because they want a weaker currency. So their exports and their commodities and the things they sell to the world are cheaper. And so because of that, the US dollar is going to remain the reserve currency of the world. So this asset price inflation that I think it's just absolutely awful in my mind, that the world only works because of this in terms of growth and in terms of, levitating financial assets. But that's the world we live in. And the Fed talks about financial conditions, and ultimately it's the Fed put. And, in every other recession for the last 100 years, multiple waves of selling in equity markets. And now it seems the whole world is about reflating by spend as much money as possible, monetize it with monetary policy, MMT, quantitative easing, and don't worry about it because interest rates are low and we can afford it. And that is going to be with us for years and years and maybe a decade or two. I don't know. But I point to the simple fact that Japan's been doing this for more than 20 years and they're not generating growth. Their economies are anemic and they're buying equities and ETFs and bonds and have negative interest rates, and it's not creating growth. It is not bullish. But that to me is now becoming a very different thing than the value of equities and assets. And it saddens me, but we are in a new world. It is different. And someday it's going to end and come crashing down, but I have no idea when, because I would have thought that the wake of this pandemic would be that catalyst. But for now, the market loves the liquidity. So policy mistakes can be a problem, right? So if we make a policy mistake, meaning the governments don't spend a lot of money, they look to get conservative, financial markets would crumble. And then the Fed would have to do more and they would call for more fiscal policy like they're doing now. The Fed's basically said, listen, we've done enough. You guys have issued $3 trillion in debt and we're buying $3 trillion in assets and our balance sheet's going up. So you need to issue more debt so we can get more aggressive on the QE. That's what Jay Powell's message has been. And that's a catastrophic reason why asset prices are going up. Because, Apple for 30 years had a PE under 20. And now that PE is 35. And somehow these analysts are trying to justify why the company is worth more today. But it's not. It's just inflated. So we've got this inflation. We've got the reflation of reviving the world to pull us out of this. And then we've got this massive 40-year plus trend of deflation and disinflation. And that's the world we kind of live in today. So what I thought would be interesting to look at is what Goldman Sachs does. Now, this is institutional, fast money, high-end investment trading that you've got to be a professional to do. Individuals can't do this stuff. At least they can try, but they can't do it effectively. What Goldman Sachs has done is created these, they've been doing this for decades actually, but it's really become popular in the last 2, 3, 4 years. They've created these thematic buckets of stocks. And they represent everything from, the strong balance sheets in Europe to weak balance sheets in Asia, so buckets you can short, to European fiscal infrastructure. So if you kind of look at one of the ones, where is it here? Is it the environment or no? There's one there. I can't remember which one. The digital dozen. So this is a basket of liquid new tech companies. Anyways, my point being that Goldman Sachs is now just starting to create ETFs around some of these types of securities. So GDAT is this digital. So go have a look at that. But it's very, very interesting ways of doing this inflation, reflation, deflation trade. And I'm telling you, this is, if you guys sit in front of screens and look at hundreds and hundreds of securities a day like I do, you can see that when a headline hits and Mnuchin says something, and then McConnell says something, and then Pelosi says something, you can see the money flow into these baskets. And they're just simply buying, everything that okay, the odds of Biden winning going up, money floods into the bullish Biden basket, and money floods out, or they start shorting the bearish Trump basket. Or a company says something about microchips in demand, and they go figure out which basket that links to, and they just go buy the whole. They have an index that's basically all the Apple supply chain. So when Apple says something bullish, you can just go buy the whole sleeve of those stocks that benefit from Apple sales going up. I mean, that's the world we live in today, and it's pretty incredible. And as an individual investor, you don't want to try to compete with that. You kind of want to understand, what's going on. So, in a deflationary environment, basically growth is going to outperform value. Okay, and a disinflationary. So when you hear the words, it's a deflation trade, money's getting cheaper, interest rates are falling. The companies that benefit from that aren't the banks. Companies that benefit from the flat yield curve aren't the banks. It's from companies who borrow and leverage. And so companies with bad balance sheets tend to do better because money's getting cheaper, and that helps their margins, and they use a lot of debt. Growth companies that don't pay big dividends and don't compete with interest rate markets tend to do better, and so forth. So you have these growth baskets and versus these value baskets. And I went back and I looked at some of these indexes. So the MSCI World Growth Index, and you can see that index on the top there. There's not an ETF at the global level for a global growth basket, but there are by regions. There's an international one, there's a Canadian growth in value, there's a US growth in value. There doesn't exist a global one, but there's indexes there. Versus the MSCI All Country World Index ETF. And so what I'm showing here in the graphic is the performance of growth relative to value since the great financial crisis going back to 2008. And you can see the difference is massive. So when Alain talked about asset allocation and where you're making your bet, ETFs are so elegant for trading these baskets and these themes. And I love them for that reason. But on an increasing basis, we've got to get more micro. It's not just about buying the S&P 500. It's what part of the S&P 500, what sectors of the S&P 500, asset allocation, are delivering. Because if you look at financials, right, they've actually done nothing in years, really speaking, because the biggest weight in the value sleeve are financials. So again, we can participate from our standpoint. We can't be Goldman Sachs. Now, I trade with Goldman Sachs, and I can buy baskets of securities like that for my private client group. I can do all that, no problem. But I've generally used ETFs, and we're looking more and more about doing basket type trades. I'll talk about that down the road. But this is very, very, I think, important for people to understand what's going on in the world today and how trading has evolved in in the last number of years since we've really computerized and digitized. But this graphic here on the left with the blue shades, this is showing periods of growth beating value. And it's gone to the point where growth relative to value compared to the incredible spike in 2000 and the dot-com bubble burst, it's even more pronounced. So the next big trade isn't technology, isn't growth, it's actually value. And that's an important understanding. Someone asked a question earlier in the Q&A chat, which I answered. Should I be buying after this correction QQQ, or this brand new ETF that was just launched a few days ago, QQQJ, which is kind of like the juniors of the NASDAQ. It's not the top 100, it's the next 100. So it's the ones that want to move up to the top 100, like a mid-cap technology basket. So which one should I buy? And my answer is basically, there's no value in that. It's all growth almost. So I think there are better things to buy, to answer your question there. And it's a shift, because we could see after these cycles end and we go to reflation from deflation and ultimately inflation, that value outperforms growth. Okay, very important to understand. I will be talking more and more about this in the next 6 and 12 months as these themes develop and mature. So let's have a look at the election. This graphic I showed last week, which was the difference from a couple weeks ago, Biden being predicted as consensus. And this, what 270 to win does, is it takes all the other guys who are forecasting 538 and everybody else, and it puts them all together in one mosaic and says, this is what the consensus is from all the people and all the websites predicting what all the pollsters are telling us, right or wrong, about what the outcome is going to be. And so for a couple weeks, it looked like blue wave, sweep across the board. And I talked last week about the differences between the different states. And let's look at 270 to win this morning. So I did the clip this morning. So, and the data is updated as of the weekend. And now Biden's 290, still well ahead of Trump. But Florida, that was tilting to Biden, is now a toss-up. And so we have a very, very close race. And the potential for uncertainty after the election and litigation in the Supreme Court, the market isn't ready for this or priced for this. And I think this is a real, real risk. And so the run-up of the last few weeks after the initial September correction has been, okay, Biden's going to win. They're going to spend even more money than Trump. Buy it, right? And so what happens is the Biden basket takes off and all the solar stocks go. And now people are asking me, should I buy the solar stocks? And right now, no, because if Biden doesn't win, I think he's going to, but if he doesn't win, then those stocks are going to get crashed. And so you don't want to chase past performance. You want to understand what the dynamics are and try to get ahead of that. So very, very interesting here. But let's look at the Senate, because again, blue wave means Senate, White House, and Congress, the lower part of the Congress overall. And when you look at the consensus, it's very, very close and too close to call. So go have a look at 270 to win. Mark it as something to look at, not every day necessarily, because it's not going to shape your trading every day, but certainly week to week. And I'm going to update this, through the election and through November and December. And once we get into the post-election period, obviously this doesn't matter because we're going to kind of know what it's happening. But at that point, it's what are the legal battles and what are all those things? Because Trump is setting up here for a massive contest. And there's a very real risk that on election night, Trump looks like the leader, and a week later, Biden is the leader because of all those votes coming in, by hand of which we know from polling 70-75% are Democratic versus Republican. So a lot of interesting things happen, but too close to call is there. Now I think the White House still goes to Biden, but the Senate won't. And so think of it. So Mitch is still controlling the Senate, and now they're trying to get the infrastructure spend again, and they still can't agree how to spend the money, except the White House is no longer Trump, it's Biden. So how is the Senate going to work with Biden and Congress, who's going to still be controlled by the Democrats? So maybe they don't spend as much, which means the market is pricing in a lot of spending that won't come, and there's less Fed and market disappointment. So lots of reasons there for the markets to come undone a little bit here in the next few months. But I think, folks, when Elaine showed those three portfolios, the traditional 60-40 balanced, the 80-20 balanced, and the 40-60 balanced portfolios, the problem overall is that the expected yield on those kind of portfolios today, in August here, but today basically is nothing. It's the lowest it's ever been in history. And so I think you need to be active, not passive. And active means different things to different people. Some people think active means going to cash. And you can do that. And cash yields nothing, so you're not giving up too much versus bonds, and it's safe. But there's so many better things to do to put your money into rather than just cash. But you've got to be willing to take some risk. So, when you ask a question, what can I buy and not lose any money and still get my yield? The answer is not very much. But there's some emerging areas that are interesting. Private debt, for example, and it's lending and anyways, I'll talk more about that in the future. But there are asset classes that are alternatives. They're not the generic stuff, and we're increasingly starting to see, ETFs built around this stuff too. So that's very interesting. I'll talk more about that on future presentations. But so a couple of the opportunities. So if we're getting a reflation trade, okay, so the reflation basket, very simply US. This is the Russell 1000 IWD, Russell 1000 value. And it's 18% financials, a lot of healthcare, a lot of industrial, very small technology, some communication services, consumer staples, discretionary utilities, and so forth. So, on a day where value's winning, today was one of those days where we saw the NASDAQ down, at the extreme, it was down about almost 2%, ended down just under 1 on the NASDAQ 100. But value stocks today were actually up and outperformed growth by about 200 basis points in a single day. So for the traders out there, these are two great ETFs that if you want to trade them back and forth, growth relative to value, you can do that. So this is the value trade for US markets. For ETF, trade them free at National Bank. But look what you own when you own the growth. You own consumer cyclicals, discretionary. You own a massive amount of technology. These are the deflation buckets. So Goldman kind of does this. They do it much more refined, very targeted, very specific. But you too can do this stuff. So, simple question for you guys. Do you want to own technology coming out of this? Or do you want to maybe tilt to value? That's going to be debated here, but growth is no longer cheap. It's the most expensive it's ever been relative to value. Interesting. So speaking of tech, you all guys have seen my shopping list. Love all these things. All of them are crazy expensive, fundamentally, technically, but I love them all. And so what I do with baskets like this is you want to own them, and then from time to time you want to hedge the risk. And so now we have the ability in our funds to use option strategies to hedge the market risk. And so from time to time, when we don't like the market risk, we can buy a put and we can hedge out the risk of the market and we can own what we like. So we can now separate the idea of even owning overvalued assets and participating in the growth of their long-term trends, because even though tech's overvalued, and large cap tech in particular, and these for now, I can still own them. I can hedge the risk away, and then once the market's correct, I can very easily unhedge those and just buy one option trade. And it's much easier to do than buying and selling them all and going to cash and doing all that kind of stuff. So there's a lot of interesting things we're doing now, increasingly in our portfolios. The markets, folks, are not getting easier, they're getting harder, and I think they might stay harder. And what I mean by that is there's not a lot of outright value and that things are cheap fundamentally. They do get cheap when we get massive sell-offs fundamentally, but they're not cheap from a risk or volatility perspective. And I suspect the VIX index is going to remain elevated well through next year until we're way past this COVID thing, or it's very clear that on a global basis, people aren't worried about it, and really economies are opening up, because economies aren't opening up. They're fundamentally saying, okay, you can now go into groups of 5 and 10 and 20, and then all of a sudden we get these spikes, like we're seeing now, and they say, okay, you can't have 10 people over, you can only have 5. Okay, you got a bubble. You can't go to the bar after 9, all those things. So until all that is free and clear, I think volatility remains elevated. So again, reminder for you, if you haven't followed our YouTube page, go there, repeats of all these webinars, this is our educational portal going forward. And so now into the Q&A period. So I'm going to take the ones that have come online this week first, and then I'll go into the written ones, and we have lots of time for questions. So let me go back to the people who started writing in early, and we'll get into all of these. So just bear with me a second while I make the font bigger for my eyes here. Okay. So uranium. Larry, are you able to shed light on uranium sector with Kazatomprom mine production? Okay, Jagdeep, I don't know anything about anything you're talking about there in terms of different mines and everything. I really don't do that micro work. Now, I have thought for years about the uranium sector as a no-brainer way to reduce the carbon footprint in the world by getting rid of coal and getting rid of all the higher density polluters to go to a much more cleaner energy and a high output energy as nuclear. And then Fukushima happened, and the view of the world changed. Germany all of a sudden says we're getting rid of all our reactors, and so they buy energy from France now, who produces 75% of it with reactors, but that's a whole other thing. So I thought uranium would be huge. It should still be, but this is one of those things where it's risk on, risk off. And you really have to be an expert in the sector and understand what's going on. And I'm just not that deep into it to make that call. So are utility ETFs overvalued? Well, let's have a look. So let me bring up a chart here and look at some of the valuations. So XLU is the big US utility ETF. So there's the picture of it. And so if we look at a 5-year picture and look technically, you can kind of say, maybe here it was, and here it was oversold, but the trend, and maybe it's a little bit above, a little bit below trend. And so, maybe slightly overvalued from a chart perspective on trend. So that's one way to look at it. If we look at it from a let's look at the some of the fundamental valuations here, and we look at PEs and cash flows and such. So when we look at it this way, we see the average PE of utilities at 23.7. You know, that's pretty darn high for utilities, but a lot of utilities get leveraged off of the yield play because they have so much debt outstanding. And because of that, and if interest rates are going to stay low for decades still, which I believe is going to be the case, notwithstanding the Fed wanting higher inflation, and I'll talk about that as that theme develops over the next year or so. But right now, so fundamentally, it's not cheap. A PE here of cheap would be, call it 12, 14 range, right? So that's the kind of thing that we'd look at. So let me see if I can do this for you here, because I know you guys don't have access to a Bloomberg terminal. Well, let's look at one of the big holdings here. Let's look at Duke Energy. So that's a big energy name. And let's have a look quickly at the drivers. So Bloomberg has this screening tool, which I use a lot of. Let's see what happens here. So this is looking at a lot of the fundamentals of Duke Energy. And it says, you know, valuation. So value versus history, it's very high, price to book value. Okay. What are some of the negatives? So when you look at some of the negative things here that are a factor and so forth. So the 3-year average EBITDA margin, free cash flow compared to long-term price value and so forth. So there's a lot more negatives in the utility sector than positives. Again, these are fundamental drivers, different ways that analysts look at this asset class. Okay, so very interesting here. So I would say it's not cheap. Technically, it's not cheap, but relative, again, so let's look at XLU. And I love the ability to do this because I can't do this kind of detailed level analysis on BNN, right? I got to give you a 30-second answer and on to the next question. But I can drill deep here, and so I hope some of you really can appreciate this and understand. So let's look at XLU relative to SPY, so the entire S&P 500. And let's look at it from what's called a beta or a risk perspective, how correlated it is with the markets. And so it is a beta or risk level of about 0.8. So it's less risky than the broad market. The correlation, 73%, is pretty high. So it's correlated with the broad markets, but it's got less volatility. It's got less risk to it. And it's got more yield. It's yielding close to 4%. Let me just double check that. So it's an asset class with lower volatility, still correlated. The trailing yield, so what it paid out in the last year, 3.15%, compared to, for the S&P 500, if you held the whole market, 1.5. So you got double the yield, a little more than that, and you've got 80% of the risk. So if that's something that fits for you, then buy it. Okay, so pretty neat there, Richard. So thanks for that question. I was glad I was able to dig deep there and do some analysis for you on how I look at things. What is my opinion of the new ETF, HCAL? I believe just out today, and thanks for doing these webinars. Kevin, you're very welcome. HCAL. What is it? Oh, a leveraged Canadian bank. So, you know, I don't love banks, but if banks were 10 or 15% lower today, I think there's fundamental value there. And so I wouldn't be buying a leveraged ETF playing the banks today until they're fundamentally cheap. Okay, so 10, 15% lower on ZEB, and you like them, this would be a good way to play them. Okay. I have heard that about 30% of the Canadian government bonds funding federal government debt are being monetized. Is this true? Can I comment? So James is asking this question. And yes, James, that's true. I don't know if it's 30%, but it's a huge part. Bank of Canada is generally buying about 5 or 6 billion worth of bonds per day. So 20 to 30 billion a week. That's a big number, right? That's a big number. In the States, they're buying about 120 billion a month. So the Bank of Canada proportionally is actually buying way more than the Fed. But the Government of Canada deficits are way bigger proportionally than the US deficits at the moment, believe it or not. Well, I guess you can believe it because every day Trudeau at 11 was giving away money. Anyways, I won't get into that. What are my thoughts on principal protected smaller large cap guaranteed return notes? Okay, so what a principal protected note was basically doesn't exist anymore, Bob. They're all principal at risk because what they were doing was they were buying a strip bond that would mature in, say, 5 years, taking the proceeds and then using that to leverage up, and so they had some risk around it, manage and so forth. So you're almost never going to see principal protected notes again. So I would check that. I think your protection is at a certain level, maybe 75% or 80% of the principal, but I would doubt very much it's all protected. And if it is, I would be interested in seeing that document because I'm pretty sure they don't exist today in that format. But basically, you're getting something that is a feature that they want to sell you because they're selling you on sleep at night. They're selling you on principal protected. You don't have any risk is what they're telling you. And in those structures you didn't, but you also didn't have huge upside. So for example, they would buy a discount note at 80 for 5 years, and that yield would say be 4%. Well, that yield today isn't 4%, it's not even 1%. And then they would take that 20% extra, they would divvy it up, and 10% would go to the house, and the advisor would get paid, and then there would be, say, 10% left, and they would buy a call option for upside, and you would get some limited upside if markets worked and kind of that kind of thing. So those are those kind of structures done with derivatives, and I don't have a big problem with them, but they're very expensive in general. The MERs, which they don't really disclose very well, can be in the 5 to 10% range. So Bob, that's what I know about those things. Given Forex changes, should I buy ZPay hedged or unhedged? The idea of buying ZPay, and the answer is both. So if you take a view, Anna Maria, for the next year, whatever your holding period might be, of what the Canadian dollar might be during that period. And so today at 132, say 76 cents, versus maybe getting to 70 or 71 or something like that at some point, you would want to own the US version. But once you get to 71 or 72 or some level where, maybe it goes more, but really you don't want to lose money on the currency, then you flip back, you trade it one for the other. And that's how I think about them, right? I buy it and I think about the currency separately, right? I don't think about them together. And so they become a different investment thinking. And that's how I look at those. So what would I buy today? I buy ZPay in US dollars because I want the US dollar exposure. If we get close to 140, I want to be fully hedged, again, 70 cents-ish. Do you have a global wheat ETF that you like with the US likely to legalize? I've added a bit of HMMJ, but wondering about diversifying further. There's one that I like in the US, MSOS. So this is an actively managed ETF that holds only US names. Curaleaf. So the stocks that are going to benefit the most are the US names. The Canadian ones will too, but they're much more fundamentally expensive than the US ones. So this one focuses on the US names only as an asset. Well, don't worry about these other derivatives kind of they have in there. Don't worry about those. The fundamental holdings are what's important. MSOS is the one I would have a look at there, Doug. Hi, Larry. Love your webinar. Can I please tell me why Alain Debienne has such a terrific headshot? Absolutely gorgeous visual. Oh, really? Come on now. Okay. You know what they say about people with big foreheads? Big brains.
Thank you, Larry.
or no hair. I don't know. It's one of those two. Okay. What is where? Oh, geez, I lost that here. What does Larry think about the? Oh, I got that one already. What was the name of the chart provider? Larry mentioned re-COVID numbers. Let me throw that up on the screen here and see if people can see that. Let's see if people can see this one here. So this is the website. It's Worldometer. They got a lot of different stats on a lot of different things, but it's not the identical number to the John Hopkins. It's within a couple thousand, 100,000, whatever. It's basically whenever a country reports something, they click the source and they show you the report, and then they add it to the totals. So today, and this ends typically around 9 p.m. So today, 396,000, biggest number ever, 6,000 deaths. US is 64,000, India, Brazil, Russia, Spain, you can see them all here. And if you want to, you can click through to the individual countries and you can see the graphics, and they lay out the graphics in terms of new cases. So you can see at 400,000 globally that we're at today, at yet another new high. So if this was a chart, you'd say it's breaking out to the upside. Right? But the great news and what Trump talks about, and he's very right about this, is that the death rates globally, even though more people are getting it, are not increasing. And it's been stable global. Listen, it's a bad thing that's 5,000 people a day on average are dying, right? It's a really terrible thing. But it's not increasing. So they're getting better at treating it. And this is a very, very positive. But at what point, you got to ask yourself the question, at what point do you say, don't care if I get it, or I've got immunity, I trust the vaccine? And to me, that's not before the election, before the end of this is late next year at the earliest, and hopefully where we're comfortable going about our daily lives and we're back to our daily business. So, you know, I think that's a really big thing here. Okay. Someone's asking, Gordon has said, what would cause ZPay to decline substantially? So what ZPay does, again, it's long about 50% of the stocks that they like with a covered call. Again, always targeting a 6% plus yield. And so for a stock like Apple, they might not like the current valuation, but so they don't like it at 120, they like it at 100. So what the portfolio manager basically would do is they go, okay, Apple, and I don't like it today because I think from a chart perspective, from a valuation perspective, however that portfolio manager who's running Apple looks at it, says, you know what? If it gets back to that long-term trend, I like it. It's at 90 today, but you project that out a few months, and let's call that 100. So can I write a put for the next few months at 100 and see if I can buy that? So let's have a look. What does the 100 put trade for that expires tomorrow? Well, it trades for a penny. Okay, so that's not going to work. How about next month's put? And so next month's put at 100 trades at 83-cent bid. Okay, what yield is that for 1 month? And so that is 80 basis points on $100. Annualize that times 12, that's 9.6% yield. That works. So I'm going to write that put at 100. I'm going to take 83 cents, and if it gets to 100 on the or below the day it expires, I buy it at 100. So here's the risk, Gordon. What if it's at 90 that day? I've got to buy it at 100. But what that portfolio manager has done is he said, I'm good at buying it at 100. So let's say it's at 90 a month from now because of election or whatever, and I bought it at 100. I didn't buy it at 120. I bought it at 100. It's better off than buying it today. And that's the analysis that gets done. And we do this in our yield fund for clients. So we look at the stocks that we'd like to own and we say, do we want to own them today? And for many of them, sure. But I want to generate that extra yield. So I'm going to write a call at where to sell it. So let's do the opposite of that analysis. Let's look at buying Apple today at 121, let's call it. Where can I write a call for November that generates me more yield? Well, turns out that I can write a call for $6. So I can buy it today at 120. I can take in $5.80, still make about 1% price, but my yield, I'm getting an extra 580. So the analysis is 580 minus the price today. So I've bought it at 121.70. I'm writing the 122.50 call. I'm getting 580 for it. That means I'm net buying the stock at 114 today. So the question is, do I want to buy it at 114, or do I think between now and next options expiring November 20th, I can buy it at something less than 114? So, okay, let's go back to the put side. What do the 114s trade at for November on the put side? So if I go long today, writing that 122 call, I know my maximum upside is around 7%, but I can write a 113.75 put and take in 370. I can get a yield of 3% in the next month and net buy it at 110. Well, does that work for me? So that's how ZPay works. And so when the markets go down, it buys more, and when the markets go up, it sells away because stuff gets called away. It's the buy low, sell high ETF that yields 6%. Who doesn't want that in their portfolio? It's my favorite ETF, and this is one of the ones I worked with BMO to create, and they do a great job at execution. There are market risks, of course. Okay, let me go to some of the mailed in questions in the last 15 minutes here. And let me go back to the slides here. I'm interested in your opinion, but a new ETF launched, HCAL. Oh, so someone asked about that already, different person. So I talked about HCAL, so that's the leveraged bank ETF. So I wouldn't buy that today. So great question there. But 10 or 15% lower, I think there's some merit there. In the view of the fast upcoming U.S. election and COVID second wave, I'm tempted to increase holdings in iVol rather than raising more cash to take advantage of an expected relative increase in overall volatility. What do you think? All right, so let's look at iVol. So interest rate volatility and inflation ETF. And I talked about this in the summer and mentioned it to people. So, just for people who don't know what it is, it's the first of its kind fixed income designed to profit from an increase in fixed income volatility or an increase in inflation expectations. So if markets collapse, inflation expectations collapse. Okay, so that's a negative for this one. But bonds would rally. right? And so bonds rallying, it would benefit from this of interest rates falling. So I don't know to what extent, without doing some more digging here, that one factor might offset the other in this. And that's the analysis that, Roland, that I think you want to do here and to figure that out. But if the markets collapse, inflation expectations go down, deflation theme outperforms, growth outperforms value, right? You see how it's now all kind of linking together, these things? So that means, it doesn't mean the NASDAQ's going to go up, but it means the NASDAQ and growth will go down less in an overall down market, right? Okay. So I would rather buy TLT, for example, if you're looking to hedge, market risk rather than going to cash. It's a great question. Really loving my YouTube channel. Our family's now using it as a resource for our grandchildren. Wow. 101 series is great for young investors getting started. Thank you for your Saturday morning market summaries. Very helpful. Tune in all the time. Wow. So thank you, Giuseppe. I really appreciate that. Thank you very much. What's my take on the level? Here it is again, the same leverage ETF one. So I did that one already. I'm curious, did Warren Buffett buy any more gold mining stocks in the third quarter this year? And are you still bullish on gold mining stocks? So I showed last week, Paul, and I'll do this again. So I have several hundred pre-made slots, charts that I look at and review constantly. And the real yield relative to gold. So this is the nominal bonds 10-year yield minus the inflation rate compared to spot gold. And this is so correlated. So what are inflation expectations relative to the yield on bonds? And when real yields go more negative, so on this graph, I've got flipped over inverse, the negative real yield, which is around 1% now, 95 basis points actually. And the lower that goes, so the higher this red line goes, the more bullish it is for gold. So you could see that gold kind of spiked, and we got this kind of swiggle here, and now we got this consolidation. But there's nothing wrong at all with that trend. And I think this keeps staying negative as the Fed looks to anchor interest rates and wants inflation to go up. So they want inflation to go up, the negative side of this, but they want to anchor interest rates. So fundamentally, this red line should still keep climbing over time. Not tomorrow, not next week, not a month from now, but over time. And it's the theme of negative real yields that have been mostly driving the gold trade. And I still like it, and I still think it's in play. And yes, keep buying dips on gold stocks. Bitcoin is attracting a lot of funding from some major financial firms. US government? No, US government isn't funding Bitcoins, Jay. I hate to tell you that. And corporate names as a store of value. Have you changed your mind on the future emerging technical trend? There is I was clicking around, what was it, the Bank of Canada? I was clicking around some research, Bank of Canada website. It was one of the central banks, maybe it was the Fed. There was a research paper out, which I took a copy of, and it talked about the need to go to digital currency and faster the better. It was maybe even on the Bank of Canada website. And so digital money is coming, but it's not going to be Bitcoin. Bitcoin will exist as an asset class that has insane volatility. For now, it's a store of value. Fundamentally, it's worth zero, and I have no real way of figuring out what it's worth. So can it be traded as an asset class, Jay? Abso-friggin-lutely. If this is something that floats your boat, I have no problem with it all. But from an investor who is governed by the prudent man rule and who focuses on risk management first. This is a nightmare. It's a friggin' nightmare to figure out how to trade it and the bandwidth you need because it's a manipulated market, Jay. Okay? So digital money is coming. Governments will always control the money supply. I think a lot of these things will get legislated away or governed to the point where people don't want to use them as much anymore because it's anti-money laundering and it's the dirty part of why people want to keep their money a secret that governments don't want and won't allow in the long run. What Bitcoin is worth, I couldn't tell you. The people that say it's worth millions and billions and gajillions, like, I don't know. I think they're snake oil salesmen, frankly, but go for it. It's not anything ever I would invest in personally or ever recommend. Largely because I don't understand how to value it. But thank you for the question, Jay. You want to do it, go for it. Frank is asking about other thematics such as staples, global infrastructure. So a few weeks ago, I taught one of the opportunities, Frank, I talked about staples, STPL, as one of those things that might be interesting as a value trade. I don't like global infrastructure. And if you want to play an infrastructure recovery, I talked about an ETF last week, FLM, which is an engineering and construction ETF. And this would be a much better way to play a global infrastructure spend. And as Biden's chances has pulled back, you can see in the last few days that that's come off a bit. So this is an interesting basket, but it's global. It's choppy. Things that Ann was talking about in her presentation about bid-ask spreads, wide, you can drive a truck through them. But this is an interesting buy and hold play thematically, not for trading purposes, but thematically to play a reflation trade and an infrastructure trade. Buying pipelines and utilities is not the way to play it, and that's ZGI. Also, the other way I like to play it is with ZMT and the base metals, because I think that's going to be a big beneficiary of building stuff back better, as they say. With Biden-Trump uncertainty in the upcoming election, how might I position my portfolio for safety? What ETF options should I consider? So I'm going to go back to something that Elaine talked about, and that is the 40-60, 60-40, 80-20. When you're risk on, you generally want more asset allocation in favor of bonds, generally speaking. Now, going forward, because yields are so low, you don't get the same degree of protection in a bond portfolio going forward that you did in the past. So don't make that mistake. But it's still an asset class that is generally low correlated or negatively correlated with equities. So you want less of a risky asset class and more of a safe asset class or uncorrelated asset class when you think you want to be risk off. So very simply, you can buy ZCON when you want to be risk off, still participate to a lesser degree, have less volatility in your portfolio, and when you want to be risk on, moderately, 60-40, ZBAL, and when you want to be risk on, 80% equities, 20% bonds, ZGRO. Those three ETFs for 18 basis points each can be as simple as it can be, Michael, for doing asset allocation. Is there a VPC ETF tracking the index of private credit index? So Frank, the answer is no, that I know of at the moment. There are ETFs that track public mortgage mix, so MORT, and mortgage REIT income ETF. So this is the public side of the privates, and why privates are far more attractive is when you look at what this has done through this year, and it hasn't bounced back, and there's serious credit impairments, where on the private side of things, private credit. In fact, we did an interview with a fund that it's only available for institutions. It's not available for small individual investors. So we have a fund of funds, Frank, for our private clients that invest in other funds that are typically only available to institutions, that diversify risk across private credit lending, generating yields of 6-7% annually, with a lot more stability than the public market debt lending, credit lending sleeves. So good question, Frank, and thanks for all those likes on my YouTube channel and LinkedIn. Thoughts on TXF? Okay. So this is an ETF that is a covered call technology ETF. And I really like it for the yield component to get exposure to technology. But here's what I want you to know, Frank, about the performance of this ETF relative to just say buying the Qs. And let's look at that. It's been out a few years, so let's look at it for a 5-year basis. And so when you're really bullish, the Qs are outperforming generally. And when you're bearish, it tends to be a bit better for the other one. But overall, you're owning a lot of the big FANG names and everything else, but it's underperformed. So covered call strategies inherently are going to underperform, just kind of being long the underlying. When you look at the portfolio, I'm not sure if I can get a look through here, but let me have a peek. So yeah, you can see some of the big names there. So effectively, you're owning the NASDAQ, most of it there. The correlation between this and the NASDAQ is going to be very high. So if I do my beta analysis here and look at the risk, and I compare this risk to the Qs, I can see that very highly correlated, right? But better return in the Qs overall, as we stand now. So if you want to own tech and be defensive and generate more yield, then maybe TXF is something you'd want to own. But if you're outright bullish, just go buy the Qs. That would be my advice there. To clarify, Raul Paul, MicroStrategies, John Paul, Tudor Jones, Jay's just telling me why I need to buy Bitcoin. Okay. If you had money in an RSP, would you invest it? If so, what, or stay in cash before the election? So Carrie, going to cash and all in and all out, it's too hard. I'm a guy who specializes in being tactical. I'm a guy who specializes in asset allocation. And I carry cash as an asset class, but it would never be all out or all in. It's just way too hard to time markets to that degree. And so if you've been defensive for a long time, the answer would be, I would wait till after the election, because the probability of an unexpected outcome is probably higher than being into the market today. And Carrie, it's the same risk reward analysis. Would I buy the market today? Would I buy it with a covered call, or would I write a put to buy it and generate yield while I'm waiting to buy it at a lower level? That's the analysis, right? So you could sit in cash today, Carrie, or you can write a put to buy the QQQ or the SPY or whatever it is that you want in single stocks at a level that you look at a chart and want to buy it at. And so take the yield. And if it gets to that price, you get to buy it. Meanwhile, you're doing better than zero sitting in cash. And I've talked about that a lot. We did that a lot. Okay. Okay, what are we, a couple more questions here. Oh, it's at 8:30. Unfortunately, we are out of time, folks. So thank you so much for your time tonight and joining us. And remember, if you can, please support one of our charities, support one of our business partners. If you want a review on your portfolio, if you want more information on my sleep at night funds, ZZZ portfolios, a review of your portfolio, etfcm.com. If you are interested in unbiased financial planning, UPotential is the best. And if you are an advisor or portfolio manager out there, have a look at Q Wealth. Thank you all for joining us. Please support us. Jared and I would love to match your donations. See you next week. Be safe. Be healthy, everybody.